Tax planning for Canadians with U.S. assets and investments. If you're a Canadian resident investing in U.S. stocks, real estate, or holding U.S.-based assets, it's essential to understand how those assets are taxed, both in Canada and the United States. In today's video, we'll walk you through income taxes, withholding taxes, the Canada-U.S. tax treaty, and important rules around registered accounts, rental income, and even estate and gift taxes. Welcome to the channel. My name is Eric Silvaggi. I'm a wealth advisor with Aegis Wealth Management, a part of Wellington Altus Private Wealth. The goal of our channel is to educate Canadians on the complexities of personal finance and to provide clarity to help them reach their goals. If you're new to the channel, please make sure to subscribe and click the like button. How Canada and the U.S. tax investment income. If your U.S. assets earn investment income, whether that's interest, dividends, or capital gains, it's important to know how it's taxed. Canadian taxation. U.S. investment income is taxed at your Canadian marginal tax rate. Foreign dividends are fully taxable and do not qualify for the Canadian dividend tax credit. Capital gains and losses are taxed just like Canadian securities. You must file Form T1135 if the total cost of foreign property exceeds Canadian equivalent of $100,000. U.S. taxation. 30% withholding tax on U.S. dividends for non-residents, generally reduced up to 15% under the Canada-U.S. tax treaty if you file the Form W-8-BEN. No U.S. tax on capital gains from securities unless it's U.S. real estate. Withholding tax and registered accounts. Where you hold your U.S. investments makes a big difference. Let's break it down. RRSPs, RIFs, and LIRAs. Exempt U.S. withholding tax on dividends. Recognized under the tax treaty as retirement accounts. TFSAs, RRSPs, first-time home savings accounts, and registered disability savings plans are not recognized under the tax treaty. U.S. withholding taxes applies and you can't claim a foreign tax credit. Non-registered accounts. Withholding taxes applied, but you may claim a foreign tax credit on your Canadian return. U.S. rental property income and filing. If you rent out a U.S. property, you may be subject to a 30% withholding tax on gross rental income by the tenant or property manager. You can avoid the flat 30% by filing Form 1040-NR to report net income. Claim rental expenses and pay U.S. tax at your marginal rate. You can also avoid withholding with Form W-8-ECI. Filing state returns may also be required depending on the location. Filing the appropriate forms and claiming expenses usually results in a lower U.S. tax bill and in some cases a refund. Selling U.S. real estate, capital gains, and withholding rules. When selling U.S. property, both countries tax the capital gain, but the mechanics differ. In Canada, capital gain is fully taxable at a 50% inclusion rate. Subject to exchange rate adjustments, foreign tax credits can offset Canadian tax. If you use the property as a principal residence, the principal residence exemption may apply, but only if depreciation wasn't claimed. In the U.S., you must file Form 1040-NR. The gain is taxed as a short-term or long-term, 15 to 20% rates. The U.S. has a rule called the Foreign Investment Real Estate Property Act and applies 15% tax withheld on gross sale price. This is reduced or exempt if the sale price is less than $300,000 and buyer used as a residence, or you apply in advance using Form 8288B. Gifting U.S. assets, tax traps to avoid. Gifting U.S. real estate can create unexpected tax bills in Canada and the U.S. In Canada, gifting to a spouse is tax deferred, but future gains may be attributed back to you. Gifting to a child or other non-arm's length person is deemed a sale at fair market value, triggering capital gains tax immediately. In the U.S., gift taxes applies to tangible assets like real estate. Annual exclusion is $19,000 per person or $190,000 for non-U.S. spouses. U.S. gift tax return, Form 709, is required if the thresholds are exceeded. There's no foreign tax credit for U.S. gift tax, so gifts of real estate can lead to double taxation without proper planning. Death and U.S. estate tax. Lastly, let's talk about what happens upon death if you hold U.S. assets. U.S. estate tax applies to U.S. situs property, stocks, or real estate. graduated tax rates from 18 to 40%. Estate tax exemption in 2025 is $13.99 million US dollars. If your worldwide assets and US assets exceed this, you may owe estate tax. Canadian residents get access to relief through the foreign tax credits and treaty-based exemptions. If your US assets exceed $60,000 USD, an estate tax return must be filed, even if no tax is ultimately payable. Final thoughts: how tax planning is essential. Whether you're holding US stocks in a TFSA or managing a rental property in Florida, cross-border tax planning matters. Without proper planning, you could face unnecessary withholding taxes, missed credits, and even double taxation. Always speak with your Canadian and US tax professionals before buying, selling, gifting, or inheriting US assets. If you found this video helpful, subscribe for more cross-border financial insights.